It's time for the personal finance corner on the show. Faye, what are we learning today?
Well, Aisha, we know that last week SEBI decided that there has to be a minimum asset under management for debt funds. Now that begs the question for the rest of us. Should we be investing in really large debt funds? Are we better off there? Is there a specific risk for investors in smaller debt funds? And of course, now that there's a minimum AUM, will there be a lot of consolidation and AUMs will now start merging funds? So what does this mean for us as investors? So to find out, let me bring in Dhirendra Kumar, CEO of Value Research. Dhirendra, thank you so much for joining us. Like I was just saying, SEBI issued a circular last week stating debt funds should have an average asset under management or AUM of 20 crore rupees in the year. What implication does this have on the regulation of our money, the money that goes into debt funds?
There is an implication. One is that there are a large number of, I would not say large number, but there are quite a few small funds. They were launched at a certain point. And the fragmentation of the category, the number of fixed income funds of various kinds being launched by fund companies, it becomes quite unmanageable to even think or even make a choice, make a selection. So in that sense, a lot of tiny funds which have been functional or they are there for some legacy, for some historic reason, they will have to either be wound up or they will have to be merged. So in that sense, I don't think it's a very alarming thing, because all the big funds, it has no implication for them. And it is a good thing for investors as well, because their choice will become simpler, and fund companies will, the funds which will have at least a basic threshold scale to be interested.
Well, Dhirendra, existing open-ended debt fund will now have about a year or so to comply with this requirement based on the date of the circular. Now, do you expect AMCs to merge smaller funds to reach that required mark? What happens to investors of those funds in those cases?
Yes, some of the fund companies will actually merge their smaller debt funds simply because many of these funds may not have a compelling business case to continue in their current form. Also, I would think that it will simplify. The other funds will, the funds in which they will merge into, they will have a larger scale, they will also become a little more economic, and they will be managed a little more intensely. So yes, some funds have to be wound up, because many fund companies, it may not be worthwhile for them to even go through the legal procedures of merging them, because merger of a fund amounts to telling an investor, issuing a account statement of a different fund. And for a small fund, in some cases funds will be wound up, but in most cases they will be merged. And it has little bit of tax implication, because if you have a long-term holding in a debt fund, then for those investors, they will be faced with a situation that they will, even in case of a fund merger or a redemption, your money will, in case of fund manager, a fund merger, it will be treated as a redemption and a new investment. So in that sense, you will be liable for the tax, which will accrue on that transaction. So all your gains will be treated, will be accounted for, and you will either be liable for the capital gains tax or with indexation or without indexation, depending on what is favorable for you. So it can translate into a little bit of tax headache for investors, nothing beyond that.
And Dhirendra, is there an advantage specifically to picking a large debt fund as opposed to maybe investing in a fund with a smaller corpus? What would you recommend we do when we're picking a fund?
Yes, I have always thought that, debt fund is a business of a scale. It is not a business of excellence, or it is not a business of, it's not a tactical fund, because most funds, they are pretty well defined. A liquid fund is so tightly defined even by the regulations that the fund manager is only supposed to do a very few defined things and do it well. And then all the advantages of a scale gets translated into economic advantage for the investor. So this is a good step. And it will also lead to, the kind of fragmentation which we have seen in the fixed income fund universe. Many fund companies launching a fixed income fund for the heck of it sometimes, or with a very minor change, and it adds to the confusion. So it's a good thing. It is a business of scale, fixed income funds of all kind, and this will translate into this. I don't know whether the fund companies will be willing to transfer or transfer this benefit to all investors as well. But certainly a large fund, I would expect that should be more economical to manage, and that economic advantage should translate into some benefit for investors as well.